Hey, good afternoon. It is Friday, March 27th, 12:47 p.m. I'm going to record this, grab lunch, and do my school pickup routine. I wanted to get a couple thoughts on digital paper or digital video. One, the US dollar was actually down 2.3% as of February or January 27th, 2026. So down 2.3%. Last I looked this morning, it was up 2.7% year to date. So that's about a 5% swing. So that's one reason that precious metal equities, gold, silver, have pulled back here as the dollar's been stronger. That goes to my second point. War has made the U.S. a relative winner. We have essentially energy independence, meaning that one of the previous podcast episodes I mentioned that in 2008 we were producing 5 million barrels of oil per day. We're at like roughly 14, 13.7. Natural gas production has more than doubled since then, too. So we are actually, and we import, you know, uh, heavy sour crude from Canada and now Venezuela. Canada's largely, they can't really export anywhere else. So we are an energy superpower in the U.S., and our economy is actually firing on all cylinders. When you look at the maybe not all cylinders. That's because there's some sectors, housing transactions are actually back to 2009 levels. That the housing market's kind of frozen nationally, but the underpinning of the economy is real strong. So the flatbed trucking index has been surging. That Dodge Momentum Index, we've commented on that. That surged last year as a future indicator of construction. I saw this morning that chemicals shipped by rail are at record highs. So, again, the U.S. is a relative winner here, as a lot of the container traffic, the energy traffic that's going through the Strait of Hormuz, that's going to Asia, it's going to Europe, and you know, in addition to that, the infrastructure there, the Qatar's, which is a huge LNG exporter, they've got 20% of that facility damaged. People are estimating that's 3 to 5 years of repair. So the U.S. now, their LNG exports are, a clear winner from this, and you're seeing that in the energy sector. But the natural gas equities are benefiting. The LNG exporters are benefiting as they kind of look down that runway. That the feared LNG glut that a lot of like Goldman Sachs and Morgan Stanley were saying we might have is now not so feared anymore. Number three, my third point. Speaking of Goldman Sachs, they have a panic index, and it went to 9.14 out of 10 yesterday. So today's Friday the 27th. Great March Madness, actually pretty good March Madness. Purdue had a good game last night. I'm looking forward to the games tonight. But so yesterday, which was Thursday, March 26th, the Goldman Sachs panic index, got to that 9.14 out of 10. So there's a lot of nervousness in the air, and you see it in the market. It's interesting because a lot of stocks and sectors that have corrected, they've kind of hit their bottom and bounced and maybe aren't making new lows, or they're showing relative strength here. So there's now the broader market though is definitely weakening, and it's moving inverse to oil. When oil's up, the broader market's down, and vice versa. And oil's been going up. We have broken out of the range though, because oil's still not above 100 West Texas Intermediate crude, and we've broken below the range that we were in that wide range that one night I stayed up all night a couple weeks ago. So we've broken below that on the market indices. Bringing me to my fourth point, bonds. Kay asked, hopeful guy, who I like the spicy guy acronym. He's hopeful guy most of the time, spicy guy sometimes. When the timing calls for it. Kay asked if TLT, the iShares 20-year plus bond ETF, is a good play here. I think so. I think bonds win either way. Either the um, gridlock is resolved in the Strait, and I think that's going to happen. I'll get to that more in a second. But if it doesn't, I think that yields will come down because energy prices stay high. So I think either energy prices come in and yields come in, or yields come down because energy prices stay high. So I think with bonds you're going to win either way. Right now there's a lot of factor models and systematic deleveraging and degrossing. Higher yields are actually driving some of the degrossing and deleveraging in the market. So bond yields have gone up, but it's going to be interesting when bond yields start going down here, maybe even when the market's down. That might be a telling point for us. So that brings us to the timeline. I have always thought that they're going to take Kharg Island and those other groups of islands in the Strait of Hormuz. Maybe not Kharg Island, but they may neutralize that and take other islands there. It could happen this weekend. I know that obviously assets are being moved in place. Uh, wouldn't surprise me if it was this weekend. Um, I don't think it would be Easter. So Trump has done these delays. The next delay goes to the Monday after Easter weekend. I can't imagine it's going to happen then. So I think it either happens now or it happens. You know, there might be another short-term extension or delay that takes us past that week, into the following weekend. So, meaning we might have to live with the volatility here for a while, and it's not easy to live with, and things are generally, the broader equity market's going down. Um, a lot of our structural long-term stocks are benefiting. Uh, Antero, EQT, Expand, Range Resources, Exxon, things, a lot of the energy stuff that we've held, Woodside, which we got via Tellurian, Cosmos Energy, which we bought earlier in the year, late last year. All these things are benefiting. I'm actually paring back some of the energy exposure, and I've tried to short oil a couple times. I've been too early. But I think oil will come in here, and now that brings me to my last point. Oil, the last I looked, West Texas Intermediate crude was 97.61, up 70% year to date. Brent's about 110. It seems bad, but we have to remember that oil, just a couple of years ago was up here in the Biden administration, and then from 2008 to 2014, oil was $100 a barrel. That's what it averaged. And if you just take CPI inflation since 2014, that average 100 of WTIC would be 150 today. So everybody's, getting, you know, uh, excited and worried about energy, but we've been at these prices before. And the economy as the global economy and the U.S. economy, which again, the U.S. is uh, basically energy independent now. We export certain products and import certain products, but we are the world's biggest oil producer, the world's biggest condensate natural gas liquids, biggest natural gas producer too. So, uh, but we've had these oil prices before, and it didn't necessarily cause a global recession or a downturn. So I know the markets are reacting. It's natural. As volatility goes up, risk managers and pod shops and things have to degross. People, are, I mean, and there's some corrections. I mean, Microsoft, I looked today, Microsoft's down 25.8% year to date. Just before this podcast I started, Qs are down 8.4%. That's the Invesco QQ Trust. The SPDR S&P 500 ETF, the SPYs are down 6.6%. TLT was down 1.6%. The EFA, which is the Developed Asia and Europe, our Developed Markets Index, is down 2.5. That had really outperformed last year. It's outperforming again. And the Emerging Market Index, EEM, is down 0.6%. So that's outperforming again. But again, the U.S. is the relative winner here, and we've seen that with the dollar being stronger. And the U.S. is actually in an advantageous position, to basically, in investment terms, they've got like a positive carry here, waiting out this conflict, are waiting to resolve it. I think they want to get it resolved as quickly as possible, but it reinforces, the dominance of U.S. energy exports, and it you know um, obviously incentivizes more manufacturing back here. So now, having said that, I do think there's going to be a resolution, and again, I think maybe this weekend they go into the Strait. We'll see. I mean, it could go. There's different outcomes there, um, but it may be 2 weeks from now. The way it's lining up as military assets get positioned, and um, and there could be a negotiation. I don't know, but so it we had an 81 degree here, or 81 degree day here yesterday, and then it was back to close to freezing overnight. I've got a sweatshirt out on the balcony. Um, so that weather is super volatile. That's a template for the markets. The markets are going to be super volatile here. There's opportunity being created. It's not easy. I mean, if you're trading, sometimes you're offsides. I talked to Kai via text, and he said, "I've learned you're not going to win them all here," and same from my experience. But it doesn't mean that you don't try and that there's not opportunity. And then from a repositioning standpoint, there's also opportunity too. So, and on that repositioning, as we saw with precious metals, when everybody gets bullish somewhere, the hot money can go out. So just keep that in mind, particularly for the energy assets. Remember, when a lot of analysts were bearish on oil, the XLE was up 10 weeks in a row into the war. I think we're working on 14 or 15 weeks up in a row now. So, narrative, I always say narrative follows price. That's one of my sayings. So narrative has completely changed. I also say conviction must be earned, not borrowed. The guys with borrowed conviction that come into some of these energy assets, like we saw in 2022, they'll go out. Now, structurally, I think, especially for natural gas, it's a probably the best possible outcome. So, with that, hopefully everybody has a nice weekend. My beard is coming back. I got to get shaving it. I can't. Uh, Looking forward to warmer weather here, and thankful and grateful for everybody in our group. Take care.